Could we finally now see a reversal in the American economy? In this video, we're going to be trying to figure out exactly this. We're going to be looking at next week's analysis, where exactly this could head. We're going to be comparing it to previous week data. And to tell you the truth, right now, it looks to be looking relatively positive, more so than it has done in the past. In this video, we're also going to be looking at some valuations. We're going to be looking at some of your favorite tech stocks and other US stocks in general to see whether or not these currently look to be undervalued, fairly valued, and if you should potentially consider opening or closing your position within them. And of course, let's not forget to mention this breakout formula here, in which we are going to start this video off with. So we can see here that there is actually a lot of stocks right now which are positioning themselves to have a potential momentous breakout in the next coming week. Anything in gold here could potentially have a momentous breakout, but you do need to do a deep dive into these companies to see whether or not they are actually justified. So to do that, we are going to just look at some intrinsic valuation formulas, but we'll get onto that later on in the video. But starting off strong here, we have actually seen a slight reversal in the US markets this past week again, which again is really, really positive. It's probably not what I have been expecting, but I do think this is a sign for things to come. We are actually climbing up here on the RSI, with it giving a value right now of 51. We are well into a short position on the MACD indicator, as you can see here, and on an exponential moving average basis, we are now below all of them, except from the 20-day, which is actually incredibly bullish. It could show that there could be potential buying pressure if we see this 50-day moving average fall below this current position, but that will just be a thing that you can only wait and see with time. So what are the factors that are driving the market at the moment? Well, there has obviously been a lot of volatility, but markets are primarily driven by escalating trade tensions, as I'm sure you all are aware now. I know it's quite a boring subject at this point, but tensions between the US and China, as President Trump's announcement of sweeping tariffs on April the 2nd led to a sharp sell-off within the US economy, which I'm sure a lot of you are now fully aware of. Despite the initial downturn, US equities began rebounding as Donald Trump's administration signaled a pause on tariffs and its further increases. Technology stocks in particular have led the recovery as the S&P 500 exited correction territory, whilst the Dow Jones Industrial Average remains about 3.3% below its pre-correction levels. And the Nasdaq Composite, having entered a bear market, still requires a gain of 6.7% to signal a new bull market. But we are seeing here that this potential MACD indicator could potentially be opening into a long position in the next coming weeks, which would signal basically the perfect time to buy for a lot of analysts, and we will see a massive bull market return. I do think the catalyst of tariffs is most likely over now. It's all kind of relying on the reciprocal tariffs at this point. If they continue to go ahead, I think we will see this continue to drop, but in between now and then, I think it's a 90-day pause. In between that period, I think we can expect to see the market recover, and hopefully trade negotiations are carried out in which they are meant to be. On the other hand, however, US consumer confidence has taken a significant hit, with expectations dropping 32% since January, marking the steepest decline since the 1990s recession. Inflation expectations have surged to 6.5%, reflecting concerns over the economic impact of trade policies. And this week, the IMF have basically announced that the world will decline from a 4.2% growth in 2025 to a 3.5% in 2026 as a result, most primarily of the result of the tariffs, essentially, which could potentially change if these tariffs were to be redacted in the future. With the UK actually being hit one of the harshest by this, as now they are only expected to grow a sad 1.1% over the next year. And the US is only projected to grow at 1.8% over the next year, down from its previous estimate of 2.7. So it's clear that the IMF is slightly concerned about the world economy. It's definitely a result of tariffs and just broad geopolitical tensions at this point. So it is something in which might be a catalyst for Trump to basically want to almost pack it in a way, and basically let these reciprocal tariffs off for good. As far as China goes, I'm not entirely sure what he's going to do with that, but I think the tariffs last time I saw anyway were 245%, and that is just unsustainable. That is not something in which you can really say you're going to carry forward for a long term. It's just basically scaring each other at this point, and it's not something in which I expect to carry on. So looking forward to next week, what implications could we potentially see? Well, investors will watch closely for developments within the US-China trade negotiations, of course, as any signs of further progress or further escalation could significantly impact market sentiment. There will, of course, be a central bank response, as the Federal Reserve and other central banks may provide insights into the policy responses to current economic climates. Statements regarding interest rates and inflation control measures will be pivotal for the markets next week. Of course, there is going to be a lot of corporate earnings reports next week, so that will be something in which is key. Last week, we saw Tesla basically give out their earnings report, and it was really not something that was ideal. In fact, they even said how the tariffs are negatively going to affect Tesla. We will get onto Tesla later on in this video, but for now, let's stick to the broad market conditions. Consumer confidence and spending will be key next week, as upcoming data on consumer confidence and spending will shed light on domestic economic outlook. Given recent declines in consumer expectations, these metrics will be crucial indicators going forward. As we can see here, the VIX is now dropping back down to safer levels in a way, so it could indicate that volatility is on its way out, but it's hard to really say, especially with the current climate of negotiations within the US markets. And looking at Schiller's PE ratio here, we are seeing this start to fall off now. Again, I would like to see this still continue, as I don't actually think that most stocks still look relatively cheap at this point. I would still like to see the US market continue to fall. That's just my personal opinion. But again, we're seeing very similar levels on a Schiller's PE to what we saw in 2022 when we had the correction then. So I would still like to see this continue, because if this does recover now, I'm unsure how long that will be sustainable for. Of course, it will depend on these earnings reports coming out. But if people or companies in this case are going to be saying that these tariffs are going to negatively affect them, then I think it's fair to say that the Schiller's PE is only just going to get worse. So we need some sort of reform within the market. We need it to either continue to go down, or we need these earnings to be absolutely incredible, and that's not going to happen if these tariffs stay in place. Okay, so now we're going to move on to a singular stock analysis, where I go over my intrinsic valuations for some of your favorite stocks. We're going to be saying if they are overvalued, undervalued. We're going to be getting some of the analyst's opinion, whether or not it's a good time to buy, and whatever else I say during that point in the video, we will find out. But first of all, we're going to start off with Tesla. Now, they are still down 38% since their peak, but despite this, Tesla has actually seen quite the surge. As of today, currently recording this on late Friday, Tesla is up nearly 10%, which is absolutely incredible, but they are at a PE of 162, which is just way too high in my opinion to buy into a Tesla stock. With some of the key drivers for Tesla being regulatory changes favouring autonomous vehicles, the US government relaxation of self-driving car regulations has positively impacted Tesla stock, as you are seeing now. Furthermore, Elon Musk announcing plans to fully launch autonomous ride services in Austin by June, which is absolutely incredible, with expansions into other cities anticipated. And of course, the fact that Elon Musk has basically said that he's going to step down from his position within the DOGE department in the US government, which means that he can now go back to being a full-time Tesla CEO, which has brought a lot of hype back to Tesla. And of course, this drive is also being driven by the broad market sentiment to buy back in at the moment. Will that last into next week? I do think it possibly will. Do I want it to? Not really, and especially not in the case of Tesla. I do think Tesla is an amazing company, but I just have it to be massively overvalued. This is the wrong sheet, just bear with. Okay, so despite Tesla being up 10% today, they are actually ranked at 77 on my breakout indicator, indicating that long-term growth could potentially not be that great for Tesla going into next week. We could potentially see a bit of a sell-off going into next week for Tesla, and on a 5-day indicator, they're also ranked at 77th. So here you can see my valuation for Tesla. I currently have this in at a sell. I have a bullish price to be set at $31 for Tesla and a bearish at 21, with a 9-year growth being set at 22 and this year only being worth $2.44. I know what you're thinking, that's absolutely crazy, that's really low, but you have to remember they are at a PE of 155, and these systems are not inherently bearish, as you will see later on in this video. But in my opinion, Tesla is definitely overvalued. I mean, especially when you just look at their PE. This company going up nearly 10% today, it's a bit of a meme stock, it's all just hype at this point, but it's an amazing company. But it's not something in which I can say is sustainable in the slightest. But we have seen this stock always high. It is one in which is just always over 100 PE. So I do think it will be sustainable, but realistically, it shouldn't be. Okay, so now we're going to move on to Nvidia. This stock is in a short position on the MACD indicator. It's just continuing to fall down. It's not doing particularly well, as it is obviously having a lot of repercussions because of the tariffs. In the top right above my head here, I've done a video recently on Supermicro, Nvidia and AMD, comparing them all, and I basically choose a bit of a winner of them all. If you would like to check that out, it's above my head, but please watch this video first. But moving on to Nvidia, of course, they are doing exceptionally well in the world of R&D. They are bringing out new chips, but they are having to scale them back for their Chinese markets, which is hurting the business quite badly. So Nvidia remains 20% down from its peak in 2020 at the start of 2025, with key drivers behind this recent surge in this last week being trade policy shifts. Donald Trump's announcements to reduce US tariffs on Chinese goods significantly boosted investor sentiment in the semiconductor sector. Shares of Nvidia rose 5% following this news, as we can see just about here. Furthermore, there was clarification from AWS, basically clarifying that they are not retreating from building AI infrastructure, countering earlier reports. This reassured investors about continuing demand for Nvidia's AI and data center chips. So again, really good news for Nvidia, and I do think this stock is an incredible buy at these levels, but I'll show you why later on. Next week, there could be potential headwinds, of course, as geopolitical risks are going to have a play. China's Huawei introduced a new AI chip, the 910C, to address the gap created by US exports and restrictions on Nvidia's chips into the China market. Furthermore, several Wall Street analysts have lowered their price targets for Nvidia, citing concerns over trade policies and AI chip demand. So with Nvidia, is there going to be potential for momentum? Well, according to my breakout system, no, there is not. They are yielding a result of 4.17, and they are currently in 87th out of 109 stocks. But for an intrinsic valuation for Nvidia, I have a high set at 185 and a low set at bang on 100. With the current price at 109, this looks to be a stock that has a lot of room to run on the high side. I have a discounted free cash flow on a 9-year basis to be set at 219, indicating that this year is only worth 24. Which is obviously massively below where we currently are. But despite this, I'm still putting Nvidia in at a buy, just because they are beating their valuation on an intrinsic valuation bullish and a mean. Nvidia is a company in which I have actually downgraded since this recent decline. As you can see here, their intrinsic valuation went from 246 all the way down to 185 on the high side and 129 to 100 on the low side. So it could potentially be a good week for Nvidia next week, but again, it all depends on US economic factors and geopolitical factors as to whether or not Nvidia does well, as of course they are the biggest US corporation. They are obviously going to be affected by whatever the government says. So as far as AMD is concerned, it's pretty much the exact same story as far as trade negotiations go. They are basically in the same place as Nvidia, but I will show you my valuation for them here. These have actually increased since the 2025 correction. I previously had an intrinsic valuation bullish to be set at 67, and now this is at 72, and on the bearish side of 36, and now it's at 38. But I still think this stock looks massively overvalued, even at $87. It's less so than it previously was, but I would still like to see this fall down more, as I think there's still quite a high PE. What last time I checked, I'll just check this now, but it's something in which I would like to see drop down. Yes, they're at a 95 PE. They are climbing up today, but again, I would like to see this actually fall back down before I would consider a position within AMD stock. But despite this, analysts are putting a general consensus on a buy based off of 49 analysts, and they have a price target of a high of 200 and a low of 90 for this stock. So AMD could potentially be a great buy at these levels, but in my opinion, according to my analysis, I don't think so. But let me know in the comments what you think about AMD. Do you think this is a good stock to be buying at these times, at these levels, or are you just going to wait for a better price? So now we're going to look at Hims and Hers. This is a stock in which has been extremely volatile over the last like 3-4 months. It peaked all the way up here at 72 and it is now all the way down at 27. So is this justified? Can we expect to see this climb back up? Well, it is now below all of the exponential moving averages, and the RSI is all the way down at 45, and it is of course in a short position on the MACD day chart. So what is the intrinsic valuation for Hims and Hers? Well, I have actually degraded Hims and Hers in the last couple of weeks. It's gone from $66 before the 2025 correction all the way down to $43 now. With the current price at 67, I still think it's fair that this stock is a buy at these levels. That is the bullish side, and the bearish side is set at 23 down from 34, indicating that this stock looks to be overvalued on the bearish side. But on a discounted free cash flow 9-year basis, we can see that this stock is meant to be worth $143. And for this year, I have them only to be priced in at $15 on a discounted free cash flow basis. So therefore, I have put Hims and Hers at a hold. And it could be potentially opening it into a buy if this decline continues. I do think it's an amazing company, and if you were to be getting in, I wouldn't say that's actually a stupid idea even at these levels. But I would like to see the price go a bit lower, as at the moment they're what do you call it, PE is relatively high still. It's all the way up at 52, and I would ideally like that to go below 40. Furthermore, Hims and Hers on a breakout indicator is 103rd out of 109, indicating that they have no breakout potential for next week. If you were interested in what could potentially break out next week, then the stocks list from Microsoft, Netflix, CSCO Systems, Palantir, Exelon, New Holdings, and so on and so forth. You can read for yourself, but you do need to do your own analysis on these stocks. If you can't just base it off of this, you need to do a valuation. And if you are interested in this, then please do hit a like and subscribe, because I will be going over these breakout stocks when the market actually starts to break out. If you are interested in a momentum strategy, then this channel could potentially be the channel for you. So speaking of Palantir, why is this listed as a breakout stock on my indicator? Well, you can see for yourselves here, they have done incredibly well. On the week, Palantir is up a whopping near 20% at this point. On a year-to-date performance, they are up 42%, with them now being back up to levels such as $110 as of recording this. They are coming back up to their peak, and to be honest, with the momentum behind them, according to my breakout system, they could potentially reach their all-time highs again. I don't think that's something in which is unfair to say. However, this is exactly why you should do your own research when you look at momentum stocks, as Palantir has a PE of 583, and an intrinsic valuation for Palantir only sets this stock at $11 on the high side and $6 on the low side, indicating this stock is definitely a sell. And in 9 years' time, we should expect this stock to be worth $83. So this is why you shouldn't just base off of purely breakout systems alone, because you could make more money. You could make more money. You could make money for sure based off of just the breakout system, but is that a sustainable approach to take when assessing if a stock is going to be a prolonged breakout? No, not necessarily. Just because it is going to break out doesn't mean it's not going to suddenly fall in such a sharp knife-like motion. So it is important to assess an intrinsic valuation. So for that reason, Palantir is not a stock in which I can personally recommend getting into, just because they are so overvalued at these levels. But that doesn't mean to say if you get into this position now, you're not going to make money, because I think momentum alone will carry this through. We are now seeing this stock in a long position here. The RSI is starting to look as if it's going to be overbought in the next coming days. And of course, they are now well above all of the moving averages. They actually weathered the storm of tariffs relatively well, which is to be expected. Palantir has just previously announced a significant partnership with Google Cloud to enhance its federal government offerings, boosting investor confidence, of course. New government contracts. The company has secured $30 million worth of contracts with US Immigration and Customs Enforcement. or otherwise known as ICE, to develop an immigration lifecycle operation system, reinforcing its strong ties with the government agencies. So that is why we have seen this recent hike in Palantir. That does kind of say it is justified. Of course, momentum will carry through, but intrinsically, I still think Palantir looks to be massively overvalued. Palantir does have their earnings report here on the 5th of May, so that will be something to keep a keen eye out for if you are a Palantir investor, as analysts anticipate an earnings per share of 13 cents, making a 62% increase year over year, with revenue expected to reach approximately $864 million US, reflecting a 36% growth from the last year's similar period. So are you getting into a Palantir position? Let me know in the comments. For me personally, I think it's a bit risky at these levels, but again, this stock just continues to grow and grow and grow, so it might actually not be that risky. So now moving on to Celsius. This is a company in which I've had a keen eye for a while now. They are above all of their exponential moving averages, which I think has actually kept them above from basically dropping down. They are slowly falling down on an RSI, but the price is actually increasing, which could indicate this could still be a good momentum stock. They are, of course, below above all of the exponential moving averages and well into a long position here. Celsius is also a stock in which I've slightly downgraded previously. I had a high set at $32 previously, and now it is at only $28. And on the low side, it was at $18, and now it's all the way down at $15. With this stock currently being priced in at $34, it's fair to say this looks to be overvalued, but in 9 years' time, we can expect this stock to be worth $117. And in this year, we should expect on a discounted free cash flow analysis, this stock to be only worth $13. We can see that this stock is currently worth 36, and the PE is all the way up at 81. So if you watch these videos every week, then you will know that Celsius has been all the way up here at the top of the breakout indicator for a couple of weeks now, but it has now dropped down all the way down to 52nd, with it yielding a result of 8.48. When it goes above 10, that basically indicates that that is then a stock in which could have breakout potential and needs more due diligence. But Celsius, it looks as if their momentum could have died down now, and we could potentially see this MACD indicator close up. So Meta is a company in which I've recently just done an analysis on. The video won't be out as of recording this or when you're watching this, but they do look to be undervalued. They have bounced back quite rigorously since their previous decline, basically because of the privacy infringement lawsuit against Meta. They do have their earnings report set on the 30th of April, so if you are a Meta holder, keep an eye out for this. So on the high side, I currently have Meta to be set at 917, and on the low side of 519, with the current price being at 533. I think it's fair to say that this stock currently looks to be a buy. But as far as momentum's concerned, I'm not sure as if they have enough momentum to carry through into next week. I probably expect this to continue to go down, especially as the RSI has peaked here at similar levels to it has done before. I think it probably will continue to decline next week. So now Supermicro, this is a company in which has just done absolutely shocking since its decline here in February. I have Supermicro to be massively undervalued. Again, if you want to watch the video where I analysed Supermicro, AMD and Nvidia, it'll be above my head right here, and you can give that a watch. But I basically concluded that Supermicro looks to be the most undervalued stock, and I think that is fair. They are, of course, in a short position on the MACD, and I expect them to be below all of their exponential moving averages, which actually they're not. They seem to be just about on top of the 20-day and the 50-day, which could indicate that this could potentially be a time that a lot of investors will buy into Supermicro, as it shows promising signs of potential momentum. I have Supermicro to be priced in at 189 currently, with it increasing from my previous valuation of 169, basically indicating that this looks to be a solid buy at these levels, especially when their PE is below 20, which I believe it definitely currently is. Despite me saying this, however, analysts are actually putting Supermicro in at a hold. I think this is mostly because of basic ETF concerns with Supermicro, as the US market is very volatile and chip manufacturers are basically seeing a massive decline within their sales. However, Supermicro, as pointed out to me by one of my commenters, doesn't actually do many sales within China themselves. I think they're 1% of their revenue comes from China, so it indicates that they shouldn't really be affected by these tariffs, even though I think they are in a second-hand sort of way. But there is a price target set at 93 on the high side and a low of 15, and the current price is all the way down at $36.31. So if it does reach the high side of near 100, then this is definitely a stock which could go absolutely parabolic. Okay, so I'll be perfectly honest, I completely forgot to record the SOFI segment, so I'm doing it now after editing the video. SOFI is at a current RSI of 58.9, so indicating that it is starting to hedge its way towards the overbought territory. It is doing really well now. It is above all of the exponential moving averages, which is only going to help push this stock further up. So what are the key drivers of this surge? Well, Citizens JMP initiated coverage with an outperform rating and a $17 price target, implying a 32% upside. Investors are optimistic ahead of SOFI's Q1 2025 earnings report scheduled for April 29th, expecting revenue and earning growth. And SOFI has secured a $3.2 billion loan platform, which has introduced new investment products, enhancing and diversifying its revenue streams. However, SOFI's 12-month average PE of 31.64 has now increased. Well, it is now currently set at 32.22, so the current PE is above the average for SOFI, indicating that this stock could potentially be heading into overvalued territories for its current position, but we'll get on to why I don't think this now. I have an intrinsic value on the bullish side for SOFI to be all the way up at 146 and all the way down on the low side of 74, which is obviously way above where we currently are, with the price being at below $13. And on the discounted free cash flow analysis, this stock should well, actually I haven't done a discounted free cash flow, as SOFI do not have any free cash flow to show for. I have actually upgraded SOFI in the last couple of months, so it just shows that they are hopefully going to provide some really strong earnings report in their earnings release. But despite this, the overall consensus for SOFI is for it to be at a hold, which I think is a bit unfair. It does have a 12-month price target at a high of 20 and a low all the way down at 5. Again, I really think SOFI can do something magical this year if the tables essentially turn, which it looks to be as if they could potentially be doing. I would like to see this open up into a long position on the MACD to give us a bit of momentum. And if you are looking for momentum, again, please do hit a like and subscribe to stay informed. So with that being said, I am going to end this video here. I hope it has been useful and you have enjoyed it. Please do consider leaving a like and subscribing, especially if you want to see potential breakouts when the market finally recovers, as I will be going over these metrics and essentially saying my own opinions, which I'm not necessarily saying are always going to be right. So you should always do your own research when validating a stock. You should always do your own due diligence. With that being said, I hope you have enjoyed this video and found it useful, and I'll see you for the next one.